invite on the show Jayesh Mehta because the recent sell-off in U.S. bonds has kept markets across the world on the edge. However, the weaker-than-expected jobs data brought some relief. Bond yields came off their 16 years high, even though they continue to remain very, very close to those levels and at elevated levels. How will this affect markets going forward? Jayesh Mehta, Managing Director and Country Treasurer at Bank of America, is with us on the show now. Jayesh, morning, and thank you very much for joining in. What have you made of this relentless rally that we've seen in the U.S. 10-year yield? Do you think what's happened in the past when we've seen these kind of levels in the markets? Is there an accident waiting to happen? Are these levels even tenable?
This level per se could be tenable, but the problem is, as you rightly said, that could be accident happening because the way and the speed at which that has happened, right? So we saw one accident last year or maybe 6 months back. I won't be surprised if we see something more happening another 6 months or so because of the pace and the way the rates have gone up. So that is a little bit challenging. We have to be careful. Global macro does not look that good as of right now. You might have some relief rallies in between, but unless there is a recession, it's not going to be in US. It's not going to be good for the bond market. So that's where the dichotomy is, right? So either you have some sort of recession, some sort of job losses and stuff like that. That will cool off these things. Otherwise, it doesn't look like cooling off happening there in US in any form. And even inflation temporarily may be coming off, but then it can sharply bounce off if there is no cool off. So their economy is actually doing well. So that's the reality, and that we cannot ignore. So from that perspective, it becomes very difficult globally because it's the big daddy anyway. So from that perspective, if that is surging, the rest of the people do suffer. But having said that, in 2005, the rates were much higher than this, and we had inflows coming. 2005 to 7, we had inflows coming in India in equity side also. So that was the large inflow, the first big wave of inflows we saw then at that point of time.
Yeah, that's true. I mean, we had a fantastic equity rally, actually. The last time US yields were so high. Glad you pointed that out, Jayesh. Let's see. I mean, they say history may not repeat, but often rhymes. That's what equity market bulls will really hope for. But, we're running into a very interesting MPC meeting against this global backdrop, right? And for us here as well, bonds yields here have been rising. I think the new 10-year is at about 7.15 thereabouts. The old 10-year paper is at 7.26. And these are multi-month highs for Indian yields. What are you expecting from the RBI? Given this very interesting mix that we have going into the decision tomorrow?
So just like consensus, go with consensus. And I personally also think no action, no change in stance, no change in rate. Yes, US has their own problem. Our inflation is quite curtailed. Of course, because of the dollar strengthening, because of the US higher yield, and to be not adding, maybe to be a little bit more cautious, they may continue to have the liquidity more towards MSS level, and therefore the overnight rate would be more in the range of 675, and that they will continue to do so. But otherwise, I don't think any change or anything happening here. I know what you have in mind.
But Jayesh, let me.
Yeah.
Jayesh, let me just expand that question. So that's your sense on tomorrow. But are you expecting US yields to remain as elevated? I mean, 4.88 was the high overnight. So are you expecting these levels to continue? And if US yields do remain as elevated as they are, then how may it impact the direction of monetary policy here for us back at home?
So as long as our inflation is curtailed, I don't think really we'll change the interest rate per se. We will manage it through liquidity tightening or loosening kind of situation. As of right now, it looks like there's no reason why should we worry about inflation. Of course, there is some scope to higher side, but I think both RBI and for us, it's also government and RBI both working together, right? So I hope, and the market expectation is that inflation inflation would be curtailed. We'll see, tomorrow we'll see the projection for the March 25 also, which will be on the lower side, hopefully. And to that extent, I don't really see the rate change happening. Yes, liquidity is the measure. They would kind of do it till the time. The good part is for us, bond yield. If you really look at it, if US goes to 5, can it go? Yes, it can go to 5. Would we go higher? Yes, the market would take it higher. But from a policy perspective, I don't think we're going to change anything. Doesn't look like at this juncture.
What about with the political calendar also being quite busy in the next 6 months? Do you think that could fuel inflation? Would you give us a longer-term view on inflation in India?
So I think most of the analysts, they are looking at, say, March 25, right? They are looking at maybe 4.5% kind of a number, right? If that is the number people are looking at, we should not be really too worried on that. Yes, we do had some food shock, but I think government is always proactive in, importing or maybe, stopping the export. They have been quite proactive there. Of course, crude crossing 120, we don't know the scenario. We haven't even seen how it will pan out for not only India, for the world. So that is a possibility. Like there is, I would say next year, I think maybe next 3 months, 6 months, 3 months, not too much of a worry. But next year is going to be pretty volatile. And more than our election, there is also election in US. So let's not forget that. And the way the geopolitics and the rhetorics are being worked out globally, next year is going to be very, very, from a global perspective. India, of course, looks very nice, very good. But then, if your global thing is not stabilized, it will impact all emerging markets.
Jayesh, finally, let's come back to that point of flows. I mean, you reminded us that 16 years ago, when US yields were as high as they are now, we were still getting a lot of flows into the equity market. What would you project on the flows front, both on the equity side and on the bond side? Because another thing that's different this time around is that we've been included in the JP Morgan bond indices, right? And there's a lot of excitement around that. $25 billion is supposed to come in perhaps sometime next year onwards. So what's the projection? And with that, tie in a view on the currency as well, which also has had a weakening bias because of this massive surge on the dollar. So leave us with some thoughts there.
So that's actually good timing for us, right? Because, nobody's sure about how it's going to pan out. I personally feel next year, global macro would look a little bit rhetoric and therefore not great for the equity markets. And therefore, you may or may not get equity flows. If you get, it's added bonanza. But the good part is, even if you don't get equity flow, normally it's like around $20-25 billion, and that will be kind of replaced by the bond inclusion. So, and of course, this flow we will start seeing coming from Jan-Feb onwards, not till the year end 23, right? So, from that perspective, at least definitely for FY 23-24, we should expect debt flows coming in, and that's a good offset in case, I'm not saying it's going to be bad globally for equity, but in case something happens there, that at least we will be at least assured on the equity flows, on the debt flows, and that should be good counterbalancing for us. And at least for next 3-4 years, this flows can go up dramatically. The only thing is, while it's very nice, generally people say, when you are included in index, it's like long short is like 10% weightage. So people might be, when they are short, they are still 8, and when they're long, they are still 12. But, delta is not 8 to 12, delta is 8 to 24, right? So when 24 becomes 8, one has to be cautious, but doesn't look like for next 4 or 5 years. Maybe future, who knows?
Jayesh, thank you very much for joining in, and look forward to hearing your comments post the MPC tomorrow. We'll get into a break. On the other side.